Aloha and welcome to the Sylvan Bell Business Growth and Exit Strategy Podcast, your guide to building companies that command maximum multiples. I'm Sylvan Bell, author of 5 books on business strategy and sales, creator of the Sell Framework, Scale Framework, and Driver Test. I work with owners of $10 million to $250 million companies, whether you're scaling for growth or positioning for a profitable exit. Each episode breaks down one framework, strategy, or concept you can apply this week to grow revenue systematically, scale operations, and maximize enterprise value. Let's get started. Today, we are on episode 20, what buyers mean when they say too much risk. And what you need to know is when you're talking to an investor, a buyer, or a private equity company, and they say too much risk, it's not meant as an insult. What they're saying is we can't underwrite this deal the way that it sits. And it gives you the opportunity to make some changes inside of your business. It's the opportunity where somebody says, I'm giving you massive clues. I'm telling you right now that we want to buy your company, but it's too much risk as it sits. And you have every opportunity to ask them why. If somebody comes to you and says, hey, we want to buy, they take a look and then they say it's too much risk, there's nothing wrong with saying, well, what did you uncover? What do I need to know? And you're going to find that sometimes there's private equity, there's investors, there's buyers that are gracious, and they'll say, here's the 7 things you got to fix. We'd still like to buy you, but you got to fix these 7 things. So risk is going to be translated into, I can't underwrite this with confidence. I can't go to my team and make the recommendation that this is a good purchase. Right? Is this a good decision for me? Is my reputation going to be put on the line for the rest of my team? All these are conversations that happen. I've talked to quite a few private equity buyers in different spaces, and I say, hey, what happens when you make a bad deal? He goes, it looks bad on me. And, you know, the investors know that it's going to happen a certain amount of times, but what companies, investors, private equity are really looking for is that, hey, we got 8 out of 10 deals that were done right. And you want to be one of those 8 out of 10 deals. So you may say, hey, Scott, give me some risk buckets. Tell me what I need to look for. Okay, operations. Do you have a good ops team? Can your operations run without you? Financials. Are your financials up to date? Do you have a closing date? Do you know that on the 8th, 9th, or 10th of every month that your books are going to be closed out? Do you know about your market? Do you know about your marketing? Do you know about the people inside of your business, the governance, and deal execution? And for every one of these, you want proof that you have structure. Every one of them, you want to be able to go and say, hey, all these things are taken care of. These are all locked up. We're good to go. And it's not just a binder on the shelf. We actually have items and standard operating procedures that we can execute, and we do daily. Investors, buyers, private equity want to know that the company doesn't have to be run on heroics. And heroics is this. There's always one person running in to save the deal, or there's always a team that's got to come in and fix it. Red flags are always undocumented processes, unclear guidelines of who does what, inconsistent delivery and inconsistent profits, and performance that depends upon a few individuals. If there's a couple of people who make the magic happen inside of the business all the time, that's heroics. You don't want that. You want a clean running company where, hey, like if somebody leaves, it may take a couple of weeks or a month to get everything back up and running, but you don't want everything to rely upon 1 or 2 people or key individuals, because it's a sign. It's a sign from the business gods. Hey, there's a problem here that really needs to be fixed. One of the conversations you're going to find when you go to sell, or as you're in this process, is, hey, what's the management like? Right? Can you leave for a couple of weeks? Can you leave for a month? Is the team prepared to run? Can they make decisions without you? It's not just can they run, can they make decisions without you? Can you call in once a week? Can you call in once every 2 weeks? Can you be gone for a while? Do people stay for a while? What's the churn rate inside of the company? Why is it that people leave? And if there's a problem with management, that's got to get fixed. I've seen this happen a couple of times where there's a really good company and they could be much better, but there's a manager, and for whatever reason that person, dude or chick, man or woman, is kept, and they're the wrong person, and key members keep leaving or team members keep leaving. That churn has a cost. So every time that you hire, every time that you bring somebody in, there should be a number associated with, like, what does it cost to hire somebody? Not just in the time that it took for the interview, but like the time that it took to train them. And it's usually, this is the magic number that most people tell me that I go by, okay? 2 months of salary. So if somebody's making $7,000 a month, it's easily $14,000 to get that person in, get them on board, and get them taken care of, or 4 times that amount. So 2 to 4 times whatever their salary is for 2 months is typically what it costs to get somebody up and running. That's expensive to have to keep replacing people. You may say, Scott, mine isn't that much. Okay, what is it? Or you may say, hey, Scott, mine is actually more. Okay, what's that number? Whatever it happens to be, those are things that you really want to figure out. Missing basics in the elements of business create doubt and create a ding on your multiple, or a dent. A ding is a little bit, a dent is a lot. And message from your sponsor, Scott Sylvan Bell, that's me. If you're getting value from this episode, here's how to go deeper. First, subscribe to my weekly newsletter, The Party, at scottsylvanbell.com. That's where I share the strategies, frameworks, and case studies I don't release anywhere else. You'll get one actionable insight every week you can implement inside your business immediately. Second, while you're on the site, download the complete Sell Framework, Scale Framework, and Drivers Test, all free with scoring guides, worksheets, and step-by-step implementation checklist. These are the same frameworks I use with $10 million to $250 million companies to build systematic revenue, scale operations, and maximize enterprise value. Go to scottsylvanbell.com right now, subscribe to the newsletter, grab the frameworks, and let's keep building companies that command maximum multiples. Let's get going. One of the places to look is, are you a governance risk? And let me just go through this bucket of what governance is. Contracts. Are your contracts up to date? Right? Do you have somebody take a look at your contract every year? Like recently for me, I reached out to my attorney, and his name's Scott too. He's an amazing dude. And I said, Scott, I haven't had you look at my contract this year. There's been changes. Can you just go through it? And he charged me for an hour of time. Now, what that does for me is that keeps me in compliance. Now, for your product, for your service, for your widget, for your gizmo that you're selling, you want to know that you're in compliance. Is your IP ownership taken care of? Is your copyright is taken and locked in? Do you own the copyright? Does somebody else own the copyright? Do you own the trademark? These are all things that matter. And if you don't, you want to get that locked down. Trademarks right now, as it sits, take about 9 to 12 months for you to get a trademark through the federal government, not through a state, but through a federal government. And copyrights right now, if you're going to copyright a book, it's going to take about 7 or 8 months. So if you're working and planning and saying, hey, I need to get something trademarked, and it doesn't go through, then what's going to happen is that's 8 months that are eaten up, and then it's another 8 months. So you should really plan for 1.5 years of your trademark to go through and for it to work. Copyright usually sails right through. You're going to plan right at that 7 or 8 month mark as well. Is clean entity structure? Is it a C Corp? Is it an S Corp? Or is everything filled out? Or are the minutes in order? Like these are all things that the new ownership's going to expect, especially if it's a stock purchase. Missing basics create a ding or dent when it comes to your multiple. When risk rises, you're going to get less money. I want to say it as plain as possible. If the risk of buying your company goes up, your multiple goes down. Buyers are going to protect themselves. They're going to give you a lower price. They're going to give you longer escrows. They're going to give you bigger holdbacks, different earnout terms, heavier reps and warranties. The structure is going to match. The structure is going to match how much risk there is inside of your business. And what you need to know is confidence is built by evidence, repeatable performance, clean reporting, transferable operations. Stories don't remove risk, systems do. So people, like when I go to look at an investment, sometimes people will start with like, it's a story. And I'm like, oh my goodness. You're telling me a story because there's a lot of risk. Like in my mind, I'm saying this. I'm not saying this out loud to them. In some instances, I do, like, oh my goodness, you have a lot of issues that are going on. As you take a look, one risk, it's manageable depending upon how big it is. Multiple risks, they compound on each other. It's a compound effect. It's a multiplication problem. It's an exponential multiplication problem. It could be customer concentration, founder dependence, and messy financials. There's 3 things right there. But those are 3 really big things. And they hold weight and gravity to the business. Like, wait a minute, I'm not buying a business, I'm funding a turnaround. I'm inheriting a mess from an individual. I really want to buy a company. I don't want to have to buy a fix and flip. Right? Fix and flips are discounted because they're a fix and flip. It's like people who go out and buy cars. You can go on Craigslist, you can go on Facebook Marketplace and literally go to where they sell cars and type in mechanic special. And what it is that car's not ready to drive. and something needs to be fixed. It could be a water pump, it could be a transmission, it could be a rear differential, it could be brakes, but you're not getting full price for that car. You're probably going to get 25%. When I graduated high school, what I used to do was I used to go to restaurant closings. So restaurant closed down, they have an auction. And auction prices are this. You can buy auction goods at about 20 to 30% of retail price. They typically sell for around 30% depending upon the product. So refrigerators, make tables, things that you'd find inside of a restaurant. If they were $100 and you could buy it for 20 cents on the dollar, that was a good deal because you would typically get 30 cents on the dollar when you sold it. Maybe 35, maybe 40. And, sometimes people would get in a bidding war and they'd have an ego and they would buy something that should be selling for 30 cents on the dollar and they'd pay 40 cents for it. 40 cents on the dollar. You want your business to be where people are going in and saying, I want to pay $1.80 over what the value is. You don't want to be bought at auction. You want to have all of your systems and options in place so you're getting the biggest multiple, so you're not being sold for a discount. And that's going to happen from proof. That's going to happen from your capabilities to show things and not just tell a story. So your job, your role, your responsibility is to build a risk reduction plan. You're going to want to document processes, strengthen your reporting cadence, diversify customer and client base, build leadership redundancy where you're not necessarily needed, that you don't have to answer all the questions, and clean legal finance hygiene. Pay the money to talk to an attorney. Get your IP taken care of, your trademarks, your copyrights. Make a dashboard that says, hey, here's what we're risked at right now, and these are the things that we need to fix. And rate them from a scale of 1 to 10. And then say, hey, which one do we take care of first? You want to take care of the biggest exposures first, because if something happens, you have a better capability of selling your business. Risk doesn't disappear, it gets engineered down. Your role and responsibility is to engineer that. Mahalo for listening to the Scott Sylvan Bell Business Growth and Exit Strategy podcast. Here's what's available to you right now. First, subscribe to this podcast so you get every framework we release. Second, visit scottsylvanbell.com to access the Sell Framework, Scale Framework, and Driver Test. All free with complete scoring guides and implementation worksheets. Third, subscribe to my weekly newsletter, The Party, where I break down strategies and frameworks you won't find anywhere else with one actionable insight every week. Go to scottsylvanbell.com and enter your email. And if this episode added value, share it with another business owner building a $10 million to $250 million company. Until next time, keep building companies that command maximum multiples. Aloha.